All
Hello,
right.
everyone. Welcome to our town hall webinar. Middle of the year, cannot believe it, 2021, here we are. And it's been quite a change from when we did this, guys, last year. Joining me here is Ari Crandall, Joe LeBlanc, and I'm Josh Kanan, Managing Partners of Premier Wealth Advisors. And excited to spend the next hour with you guys to try to answer as many questions as we can possibly answer around your finances. Welcome, fellas.
Thanks.
Good morning.
Good to
Good
see
afternoon.
everyone. Yeah. Whatever it is. It's just Tuesday, right?
Exactly.
Yeah. I just got back from a 10-day road trip, so I'm still trying to get in the groove, guys. So.
Yeah, you had a good one. Went to some national parks, I think.
Yeah,
correct?
Zion, Grand Canyon, Sedona. So we are well hyped and ready to go back to work. So
nice.
Yep. Anyhow.
Well, we've got quite a few people on the call today, and for those of you that are new to this setup, we are not live mic'd, which means everybody's on mute because we have too many people on the line. So in order to ask questions, there's a chat function on the left-hand side of your screen, and that's where you can just ask a question. You can either send it to all or just send it to the presenters and let us know what's on your mind. You know, the idea here over this next 45 minutes to an hour is to just kind of speak about what's happening out there and ask questions that we might be able to address. Certainly from a tax perspective, Joe and Ari are well versed. And then we're all certified financial planners. So we got a pretty good, well-rounded knowledge of anything finance related. So let us know what's on your mind, and we're here to help and answer questions throughout this time period.
So, Josh, you provided a quick list of stuff we can cover today. Do we maybe want to go over those bullet points to maybe stir some thoughts and get some questions going?
Yeah, absolutely. And I think, the things that we got in advance, we heard a lot of things in advance. So we'll kind of cover some of those topics for sure. But, Biden tax hike proposal is something that's on a lot of people's minds. There's, that conversation happening in the media consistently and what that's going to look like. We've had our own presentations on that in the past. But at this point, we don't have a law in place. And so we can address some of the speculation there. Inflation's a hot topic, guys. We've heard this quite a bit from our clients and certainly also well in the media. Whether this is something that's just a transitory type of inflation where it's happening because of the pandemic recovery, or is it something that we should be concerned about more longer term? Is it more of a permanent increase in pricing? So that's one. Cryptocurrency is a hot topic. We've been hearing a lot about that. Where does it fit in? Is it something we should be investing in? How does it fit into an overall diversified portfolio? Or is it just speculation and frenzy? So that's a question. The housing market. Wow. I think when we, back in 05, 06 and before the Great Recession, we talked about a big housing boom. This one, I think, is rivaling that for sure in the sense of how we've seen this housing market be so hot. So we'll talk about that. Which is, another piece, which is the low interest rate environment. And kind of there's a lot of conversation with the Federal Reserve about when they're going to start raising interest rates. So that's also something. We've heard a few folks, reach out to us about, whether or not the stock market's now in a bubble. So we'll address that issue and question. And just continuing on with this pandemic recovery and what the second half of 2020 might look like. So those are all questions we got in advance that we certainly can address throughout this conversation. So where do you guys want to get started?
I think the most common question I've been getting, guys, is around inflation and housing prices. Those are probably the top two. When I think about the last, 2 or 3 months of client inquiry is, inflation and housing. I've seen a lot of refinance activity, a lot of, I think we're going to sell and move. Now's the time to kind of make that adjustment. Rates are really low, so we can get into the house we want, right? We're hearing that conversation a lot from folks. When I went to Home Depot, gosh, a sheet of plywood was $80. It used to be $12. What's going on there, right? So so maybe we can start there.
Yeah, and a lot of these things go hand in hand, and just from a kind of definition sense, inflation is just a rise in the cost of goods and services. And so exactly, Ari, as you just mentioned, seeing the cost of supplies increasing at Home Depot, seeing the cost of housing increasing because housing prices are rising. Those are inflationary pressures because
Mm-hmm.
it's causing everything to rise in cost over time.
Yeah, yeah. The building material prices are kind of an interesting phenomenon, and I think that's a little bit more of a supply demand economics thing than a overall inflationary, debt inflationary concern. The what happened during COVID from the research I've done is, the sawmills and producers saw that there was going to be a reduction in demand, and so they just stopped, producing inventory. And the exact opposite happened in that there was an increase in demand. So you had a reduction in supply and an increase in demand, and you just do just simple supply demand economics at play on a lot of that. Kind of more short term in my perspective on those items.
And that's the lumber prices is one that's a perfect example of how it can turn quickly. I mean, we're already starting to see lumber prices come back down because as soon as this started to become a problem, all the sawmills started, going into overdrive and working, 24 hours on the clock with 3 different shifts and started to produce more supply. And so
Right.
now all of a sudden you're seeing those prices come back down. Not all commodities can work that quickly, or not all, and all prices can come back down that quickly. But yeah, that's an example of more of a transitory type, situation where as a result of the pandemic, the supply demand got out of whack. And now we're seeing it kind of come back in line. And I think that's the big argument out there right now. The Federal Reserve or the government's, discussion around inflation is that it's something that is under control and that it's something that can be, it's more of a shorter term phenomenon because of where we're at in this recovery and the fact that we had such a displacement. And now things with all the pent up demand are shooting back. And that's kind of the argument for the more transitory that eventually it's going to come back down to where their target is, which, as you can see on the chart, their current target for inflation is 2%. And that's where they'd like to see it. Well, I think all of us know right now that prices are a lot higher or increasing at a higher pace than that. And so the other argument is that that's going to be more of a longer term trend towards a higher inflationary environment because of all the stimulus and all the money that's out there floating around the economy. And there's some valid argument there that could be something that gets a little bit more out of control. Now, I don't anticipate hyperinflationary environment by any means, but I think you could argue that you might see something higher than the 2% target that they're forecasting.
Yeah.
Yeah, definitely. It's 2% is a target, and they're not always going to hit it. When they pull the levers at the Fed, it doesn't react instantaneously to reverse whatever course it's on. And so that 2%, they're trying to get there, but it's always guardrails. Definitely in kind of macroeconomics, the deflation, which is kind of those blue areas on the chart back in the Great Depression, are much worse. And you can see, except for the 2008 recession, we haven't had deflation in a long, long time. And so even if we're in the 4 to 5% range actual inflation, that's not necessarily bad compared to a deflationary period.
Right. And then kind of bringing it back to home, what we're seeing is, right, wages are going up, minimum wages are going up, the cost of labor is going up as well, right? Because there's a little bit of a shortage in the labor pool. So for attracting and hiring, companies are having to offer more money than they normally would. And eventually that will trickle down into higher cost of goods sold and higher prices across the board for a lot of folks as well, right?
Well, even the pressure on higher minimum wages is
Right.
causing wage inflation. So, and we're seeing that national.
And that's something that I remember, and I've said for a long time now. I said until we start to see real wage inflation, I don't see inflation being a problem. And now we're starting to see real wage inflation. And
Right.
so that's where I tend to lean a little bit more towards this. This is maybe something where it's not all transitory, in the sense that, it's very clear that they're having to offer higher wages to get employees and get quality employees to come and work. And so that's something that, in just conversations with other business owners, I'm seeing across the board. I had a review meeting with one this morning, and she said that she's having a real hard time finding some employees, and she's had to increase salaries. So I see that as being something to keep our eyeball on, and something that gives me a little bit more in the outlook that, hey, we could see a little bit more into the 3 to 5% range of inflation as we move here over the next handful of years, and that's reality. That's something that could be realistic. And so then the question, guys, and I think this is where the folks on the line would want to understand is, well, what do we do about it? If we're having a little higher inflation than normal, what type of strategies do we have to implement, or what do we have to pay attention to make sure that we're protected against a higher inflationary environment?
So a couple things to think about really quick in terms of portfolio structure and in terms of inflation, right? Because we have a few questions, right? One is, what do higher interest rates do? Higher interest rates do what to the market typically? So that's question number one. And a similar question, are bond returns starting to rise yet, or when will inflation start to drive them? You guys have any comments on that?
Typically, interest rates, work opposite with the stock market. So higher interest rates, higher cost of, funds for companies to, create projects, buy inventory are, negative for the market. Not that it's going to cause negative returns, but simply, decreasing the expected return of a particular stock or particular company. But, you see that move back and forth within limited, scope. We're not going to see interest rates go from, currently 0 to 0.5% to 10% in any short period of time. But certainly if they move from where they are now to 2%, that'll have a small impact on the stock market. So I wouldn't be necessarily worried about, interest rates in the short term and, stock valuations.
But I think, Joe, but the reality is, we just saw it last week. The Federal Reserve comes out, talks about the fact that, hey, they are, got their eyeball on inflation a little more than they originally anticipated, and therefore they're thinking, they're going to have to raise interest rates maybe a couple times in 2023, maybe even once in 2022, and all of a sudden the market gets spooked. So
Right.
in reality, in the real world, whether that has a significant impact necessarily on the businesses that we are buying when it comes to the stock market, from a behavioral standpoint, the reaction is, oh no, interest rates are rising, and that causes volatility, it causes uncertainty. And so I do think, the message is, yes, higher interest rates will cause markets to be volatile, because it's just not something that we've been used to for a while, right? Because we've been in this extremely easy money environment. And if the conversation is that that's about to change, then I think markets will have volatility. They'll move up and down, and as they try to figure out how that impacts these businesses.
Well, like all market volatility, though, isn't it? It's just uncertainty is what drives the volatility, right?
Sure.
Right.
Not necessarily the economics around the companies, but the uncertainty of policy in regards to what that might do to
Right.
profit.
It's uncertainty and surprises.
Yeah.
So when the surprise, interest rate jump kicks in, that's what causes the market to have generally a temporary decline in prices. But the long term, once the market or, the people that are moving the markets get used to the current interest rates and see that the companies are still, operating, creating profits and, paying dividends, then that, effect tends to go away.
Sure. And
Yeah.
and some people would argue a little bit of inflationary pressure is sometimes good for the markets, because oftentimes it's not significant enough to impact demand. And those increased costs mean increased profitability, which bodes well for stock performance as well.
Exactly.
And you can see just right here on the chart that's on the screen. I mean, this is how quickly things can react, right? So all of a sudden the Federal Reserve speaks, and then the chart here shows a huge jump up in the probability that the Fed, has a rate hike in 2022. It's up to 50% from 30% just a week earlier. So that's how quickly these things can change. And I do want to address the other question around bond returns, because when we think about inflationary pressure and then ultimately the idea that you have to increase interest rates to counter that, well, right now the question was, are bond returns starting to rise yet? And the answer is no. Right now, the 10-year Treasury is currently at 1.47 or 1.5%. That means you're basically buying a government bond and locking up your money for 10 years and only getting a 1.5% return on your money. We have not yet seen interest rates, reflecting the fact that we're in an overheated economy, which is interesting because you would think with the expectation of higher economic growth and potentially higher inflation that you'd see those Treasury yields start to increase, and we just haven't seen it yet. And so for those folks that are sitting in money market accounts and CDs, and on the shorter term side, which is also where the Federal Reserve comes into play, you're not seeing any yield on your money in this current environment. And that's going to be an interesting part to see where that ultimately changes, because I think for retirees, it's one of the biggest challenges people face, is trying to be conservative with their money, but not able to get a return on that money. And if we just said that inflation is going to be in the 3 to 4% range potentially, and you're earning 0.2 in your bank account, you're losing money every single day.
Yeah, it's another reason, also when we think about our portfolio allocations, right? There's no reason, in my opinion, to be going out and looking for long-term bonds, right? In the allocations, right? You want to look at those allocations and keep those maturities short, so that you can capitalize on those movements and increases in rates, and that way why go into a 10-year bond at 1.5% when rates are eventually going to go up? It just doesn't make sense to lock your money in at those longer expectations.
And if you look at, bond pricing and just think of the housing market, the mortgage market, as interest rates have come down, what do people do? They refi at a lower interest rate. Well, bonds do the same thing. Anytime a company or a municipality can refi their debt at a lower rate, they're going to try to lock in at the lowest rate for a long period of time going forward. And so, as interest rates start to move back up, that's having a negative effect on bond prices, long-term bond prices. And so, if a municipality is locked in at 3% and all of a sudden, bond yields go to 5%, you're not going to pay par value for a 3% bond. The cost of that bond is going to go down. Maybe it goes down to 80% of par value. And so that's the risk on long-term bonds, is as interest rates move up, the price of long-term bonds will go down, moving out in the next 5 to 10 years.
Yep.
So I think I want to make sure we address one of the big things I think is important to take away from this topic before we move on to another topic, which is, what do you do to deal with this inflationary pressure? And one of the other questions we have right now addresses this as well. So we just mentioned we don't want to be in long-term bonds. We want to have shorter-term bonds to deal with the fact that interest rates could be heading north. And so that's one element. The other piece then becomes, what other ways can you protect yourself against inflation? And so there's three other ones that I think are worth speaking to. One of them is, real estate's always been a pretty good hedge against inflation. We always hear about real estate as being a great hedge against inflation, because as prices rise, you can charge higher rents. That ultimately increases the value of your real estate if you're in investment property. But the other one, and as much as we just talked about the fact that rising interest rates causes markets to get volatile, it's still the best long-term inflation-adjusted returns belong to stocks. Owning the great companies throughout the U.S. and the world has been one of the best hedges against inflation in the history of markets. And so that one, is certainly out there. Another one that stands out that you hear a little bit about are Treasury inflation-protected securities, these things called TIPS. That's another way. If you're going to have some bond exposure in your portfolio, maybe adding a little sliver to TIPS could be a way to hedge against inflation. The thing there, guys, is you got to keep in mind, they only benefit or become good if inflation's higher than what the expectation is.
Right.
It's not just inflation in general. So that's another one. But one of the questions is, what about precious metals? And this is a very common myth that owning precious metals is an enormous, great hedge against inflation. And if you actually you look at the historical data on it, it's really not. And gold, silver, all these other types that you can even argue now that the newer,
just commodities in
general. But I would say the precious metals specifically, though, have not historically been a great hedge against inflation.
In my opinion, the precious metals play is an emotional play for people, because most people who are going out and buying gold and silver are actually buying the physical gold and silver that I've spoken to. And they want to open their safe and look at it and say, oh, look, I still have my silver bars that I bought. No one I know that ever buys that stuff ends up selling it to replace the roof on their house or go pay for a vacation. They hold it in perpetuity, generally speaking, and then pass it on to their kids. I don't know anyone who's buying and selling commodities, gold and silver in particular, the most common ones, palladium as well. I haven't run across one person who said, hey, I went and cashed that in and I went down to the grocery store and bought a loaf of bread with it.
Yeah, and there's a place for that, guys. And I think the place for it is it's for that kind of worst case scenario, right? I use it, I never, poo-poo the idea of somebody owning some precious metals, but it's not for the purpose they think it is. It's more like, to your point, Ari, it's behavioral, and you're really hedging against the, oh my gosh, the dollar has collapsed. I need this worst case scenario. I need to go into my safe and grab something that I can actually barter with. That's where you're looking at the precious metal as being, because beyond that, it doesn't pay dividends, it doesn't pay interest, and it's purely a speculative play around the price of that underlying precious metal. So to us, it is kind of a hedge against the real worst case scenario, Armageddon, doomsday type scenario.
I have a client that jokes around, he has some, and he goes, Ari, I need something to bribe the border guards of Canada when things fall apart so I can get across the border. That's his joke to me about why he holds it, right? So, but we have some data that we can share on this. So we had a question about, hey, can you send me some data around the precious metals in particular? So we can get that out to you. Just send us an email, and we can send you some information.
Absolutely. So the last thing I'll just kind of end with on this topic is, the study out there the survey amongst a lot of the banks out there are that this is transitory more than permanent. But I would say that if you were asking I would say it's more of a 50-50 than a 72-23 as to where this ultimately lands. At the end of the day, as Joe mentioned before we started this, we're not going to know until several years down the line as to whether or not it's more of a permanent phenomenon.
Mm-hmm.
Yep. And probably, if you look at a big picture, there's some component of both in inflation. So there's a spike that's transitory, but some of it, wage inflation is permanent. And so, we'll see both factors of that.
Mm-hmm. And it'll be also interesting to see just kind of globally how things play out, because the COVID situation is so different from country to country and region to region in regards to how it's impacting the economics of those regions. So it'll be interesting just from a perspective to see on how that kind of plays out. We have a pretty good handle on how it's working here in the United States. We have no clue on how it's working in other countries, developed and second and third developed countries, to see the impact it's having on, ultimately supply chain issues and so forth.
There is one piece of good news around this inflation discussion that just came out, I think a week or so ago, that the potential cost of living adjustment on Social Security, which doesn't actually officially come out until October, but the speculation at this point is that it could be as high as 5.3%, which is the highest it's been since 2009. So that would be very positive for those folks that are collecting Social Security, is getting a nice bump on your benefits. Once again, doesn't come out officially till later in the year, but based off of a report that just recently came out on the Consumer Price Index, it could be as high as 5.3%.
All right.
So that's good.
Yeah.
Next topic. I'm getting a lot on this, guys. I don't know about you, but certainly there's plenty of talk around, what's the tax law changes going to look like? And I know we've covered it a couple times in a variety of ways. We know kind of the basics. But now I think it's getting to the point where, is this now something that is going to be retroactive to 2021, or now are we looking into 2022? What's the talk around the current tax hike proposals? And I know specifically I'm getting a lot of questions on the capital gain issue and what that might look like.
So there's kind of two equations around that. One is if you look back historically at tax reform, the longer, or I should say, tax hikes are usually in the future. So they say, we're going to increase rates to whatever it happens on January 1st of the next year. Deductions are usually retroactive. And so they say, we're reinstating the mortgage interest deduction. That goes back to January 1st of the current year. That is typical. However, if you look again historically at all different tax reform, the longer in the year it takes to enact it, the more likely is it's going to be effective forward and not be effective backwards, with the exception of those deductions and what were called extenders. An interesting part in the Biden proposal on the capital gains tax in particular is there's one little phrase in there, and then it says, as of the time of proposal. Now, it is a proposal, so that's up for negotiation between the Senate and the House and the Democrats and the Republicans of when it does become effective. But they throw that little placeholder in there as something, put a peg in the sand, put a peg on the wall, whatever you want to call it, line in the sand of, hey, that is the president's desire to make it effective much more immediately. And everything is negotiable. That's the other part of it. No matter what the president has proposed, it has to go through the negotiation. So we did see he's already walked back on some things in order to get like his infrastructure bill passed. He walked back on some other tax proposals, but we have to kind of wait and see.
Yeah, it's not law until it's law, and until then, it's all proposal. And there's always some bartering that takes place, back and forth. So, nonetheless, there'll be some change. We just don't know the full impact of the change.
Right.
One good thing that's happening in 2021 from a tax perspective is there is some advanced child tax credit payments happening. So I'm sure people have maybe they've gotten some letters in the mail. Those letters were supposed to go out within the next few weeks or last week, I believe.
I think anybody with children of the right age got the letter, because
Right.
I got it. Several of my clients that are way above the threshold for getting that advanced child tax credit got the letter, because the first letter just said, hey, this is available, and we'll send you in June, July another letter saying how much we think you're actually going to get.
Right. So I'm just going to read really quick. I have it pulled up here on another screen. It's right off the IRS website for those that are curious. So this advanced child tax credit payments, you qualify if you and or your spouse, if you file the joint return, you have to file a 2019 and 2020 tax return and claim the child tax credit on those returns, or you've given them information in 2020 to receive an EIP payment, economic impact payment, for non-filers. So obviously, you have to have a home in the U.S. and a qualifying child under the age of 18 at the end of 2021 that has a valid Social Security number. So they're automatically going to enroll you for those advance payments. You don't need to do anything to get those advance payments. And the amount of the credit for 2021, if you fully qualify, for tax year 2021, it's increased from $2,000 per qualifying child to $3,600 for children under the ages of 5 at the end of the year 2021, and $3,000 for children $3,000 for children ages 6 through 17 at the end of 2021. So they are supposed to be paying this out in a monthly installment in advance for half of the year. So I'm assuming half of the credit for half of the year, and the rest of it will be sorted out on the tax return once it's filed.
Right. The advanced part is 50% of the total,
Right.
but because there's only 6 months left in 2021, if you qualify for $3,600, you would get $1,800 of that, or $300 a month per child between 0 and 5 years old, or $250 a month per child from 6 to 17. And that's one actual change, is now 17-year-olds qualify for the child tax credit. Previously, once they turned 17, they were no longer eligible for the child tax credit.
Right.
So it did extend it by 1 year.
Yeah. And there are, adjusted gross income limitations. Well, they'll modify it and phase it out, and that's based on your tax return filing. And if the numbers differ from year to year, they'll true it up and so forth, kind of like they did with some of the stimulus payments.
So one of the questions I'm getting, and that's great, that's certainly something that I've been hearing about in the news, and so thanks for sharing that, because I'm sure a lot of people have wondered. But one of the questions, guys, is regards to capital gain taxes. And one of the things I think the message to the listeners out there is, and this is something we've talked about before, is kind of the crosshairs as to who's impacted by higher taxes are folks making $400,000 or greater, and then specifically the $1 million income level or greater is really getting hit with this capital gain increase and qualified dividend increase. And so maybe you guys can maybe Joe can shed some clarification around that and what they're proposing on that particular tax for those income levels.
Right. So exactly, as Josh said, incomes above 400K are in the crosshairs. Gain above $1 million is in the crosshairs. The good news is it's only the amounts above that are going to pay the higher tax. So if your total income, what's called your AGI, adjusted gross income, is more than $1 million, only the gain greater than the $1 million would be subject to the ordinary income tax rates. You'd still get the preferential 20% capital gain tax on your gains such that your AGI is less than $1 million. But let's say your AGI, because you sold a piece of property, is 1.5 million. That additional 100,000 is going to be subject to potentially 40% tax for federal, plus guess what, 9.3 or 10.3 for California. But the much higher tax rate just on the amount above $1 million. So that's the first piece of good news. Again, it's still subject to negotiation. That is not set in stone yet, and who knows where it'll end up exactly. But probably, if I was a betting person, I would say the Republicans may give on that, because it's affecting a relatively small number of tax returns. It's estimated less than 1% of tax returns have AGIs above $1 million. And so, I think that's a giveaway on the Republican side, as far as, give that to the Democrats and then pick up something else somewhere else.
Yeah, so just as a refresher, the current highest capital gains rate's 20%, plus you got that 3.8% net investment income tax. So maybe you're at 23.8 federally, and then this potentially, if they're able to get the highest tax bracket up to 39.6, then you're at the 39.6 plus that net investment tax, and then the state. So you're talking well over 50% for those taxpayers over that $1 million. So certainly is going to be a significant change for those people that are impacted, but to Joe's point, not a lot impacted. The other question before we move on to a different topic is around this estate planning aspects of the tax. And that's been a very hotly contested piece of this legislation or potential legislation around how certain businesses are passed to the next generation, or different types of property. And right now, the inheritance or the estate tax exemptions a really high number, guys. It's like 11 million plus a person, almost 12 million.
12 million.
So you have to have a pretty good size estate, especially as a married couple, before you have any tax issues. That's certainly being looked at as being reduced dramatically. But then there's a big question around the tax-free gain that you get upon passing assets to the next generation, something they call a step up in cost basis. That's potentially being eliminated. And there's proposals actually out there that are pretty scary on this particular one, because of how impactful it could be for people that own businesses or are passing along businesses to the next generation.
And again, this is one of those things where, you have to run the numbers, or, they've looked at the numbers of how many people this affects. And so the proposal currently is to reduce the estate tax exemption maybe down to $1 million for capital gain exclusion. And so again, that's one small little bright point, is getting rid of the step up in cost basis, meaning grandma bought AT&T at $2 a share, and now it's at $200 per share. Under current rules, that $198 gain gets erased when she passes away, and the inheritors could sell that stock the very next day for no capital gains. By getting rid of step up in cost basis, that would become taxable for the inheritors. But the proposal actually has $1 million carve out. So the first $1 million of gain would still have a step up, and everything over that would not. So that's where they do the math and say, okay, how many people are affected by that? And again, it's less than 5% of estates pay any estate tax, even at $1 or $2 million of estate tax exemption.
It's just interesting to me that I mean, how are they going to track this stuff? That's the other question, right? I mean, how do you know what that person paid for that stock when they bought it forever ago, and it's split into 4 different companies, and then they got it from someone else? I mean, right? So the tracking, there's going to be some tracking error there for sure, which is another kind of quirk around the law, in my opinion. Or, how do they know what it can apply to a home, right? That they've had for a while. Like, how do they have that information on a home that was inherited, for example?
Right. Well, they don't, and that's the whole idea of step up in cost basis is,
right.
You don't know for sure what grandma paid for that, share of AT&T stock, but on the day she dies, it gets revalued to that particular price, and so that's your new cost basis.
Yeah.
Part of the proposal is to make death a taxable event, and so that would cause that true up in cost basis at that time, which then makes the reporting a lot easier going forward.
Right.
But the question is, how much of an exemption would apply? And so again, that's probably the part for negotiation between the two sides, is how much exemption will still be there that would not be subject to that tax rate versus, is everything. And another interesting part is the proposal wants to assess estate tax on any entities that have not been taxed in the past 90 years. And so they're looking at those large family trusts and not foundations that are charitable, but family trusts, even corporations that did not pay estate tax since 1940, being reassessed in 2030 and having a taxable event at that point.
And that's getting a lot of farmers up in arms because of like family farms that have been passed around for generation to generation, where they don't really have a lot of liquidity to pay a big tax.
Right.
And yet, all of a sudden now you've got this big tax event. Now they're saying you could maybe spread that tax out over a 15-year period of time. But still, certainly, an unexpected event, taxable event, where all of a sudden you got to come up with a chunk of money. And in a situation of a farm that maybe has a zero cost basis, or very low from 30, 50, 70 years back in time, and then all of a sudden, it's might be worth a pretty good chunk of money that's now being assessed. So yeah, those are things that are out there, without getting too far into the weeds, guys, but it's something that we got to keep our eyeball on. It could have impact to a lot of folks, although, maybe not as many as initially estimated, but certainly could have impact to folks that have some of these businesses and entities out there.
Hey guys, we have a question around Prop 19 and cap gains and so forth in relation to that. Do you guys have an opinion on that? I know it's kind of, California is a little not 100% clear on all of their guidance and so forth.
Right. So Prop 19 actually deals with property tax, not capital gains. And so just like with a house, you could have a property tax reassessment on inheriting a property. And that's what Prop 19 is getting to, is you get $1 million exemption from reassessment on an inherited property, and everything above that would be reassessed. So if grandma's house was worth $2 million and it goes to the grandkids, under old rules, that $2 million was not reassessed if they maintained it either as a rental property or one of them moved into it, as long as they kept the property. And so the property tax basis was really low based on grandma's property tax basis. Now there'd only be $1 million exemption, so there'd be a reassessment on everything above $1 million, and the property tax rates would go up even if the kids hold the property. And so that's really Prop 19. It's separate from capital gains, but it does kind of work hand in hand, to the sense of all of a sudden your property tax rates go up, and maybe you decide to sell the property, and then capital gains tax hits.
Yep. Yeah.
One of the other differences on that, and correct me if I'm wrong, guys, is you can now, like the existing laws, you can do that one time. Now with Prop 19, you can do it up to 3 times in terms of transferring and being able to transfer that property tax base.
Well, that's the not the parent-child exclusion, but the owner-occupied, your primary residence. You now have 3 times to transfer your property tax basis to other primary residences. And one of the nice things about Prop 19 is it extended it across the entire state. Previously, there were only 10 counties in California, and I think there's 50-something counties in California. Only 10 used the property tax reassessment, where you could move from one property to another as your primary residence and not get reassessed.
Yep.
Only 10 counties allowed that, and it wasn't necessarily inter-county. So if you move from San Diego to Orange County, you didn't necessarily have that privilege. Now that privilege goes all statewide, all counties, and up to 3 times. But again, there's $1 million limit on doing that. So if you sell your house for $2 million, you're not going to keep your $300,000 property tax basis on your new property. It's going to go up some, but $1 million worth would be excluded from reassessment.
So to answer the question from the chat box, is it's nothing to do with capital gains. It's property taxes specifically.
It is
Prop 19.
Right. It's still based on appreciation.
Yeah.
And there's, again, I should say not again, but unfortunately, the rules have not been totally clarified yet. So the Franchise Tax Board has to lay out the rules. So, California passed the law. That's one thing. Now the Franchise Tax Board has to come up with the rules on how that applies. And then each county assessor has to say, okay, here's how we're applying it. So that process hasn't worked itself through. And for instance, there is some talk about, having an LLC. So if you have a rental property in an LLC, does that actually get sold when somebody inherits it? And so in some cases, an LLC, an entity, is not actually changing hands, or I should say that the entity is changing hands, but the property is not. And so the property tax rules are slightly different in that respect.
So it's one of those things where it's like, let's see how it shakes out and get the final word county to county and statewide.
Right.
Hey, let's shift direction a little bit, guys, because we're at 12:43. I want to make sure we kind of cover some other topics. We haven't really gotten into cryptocurrency. That's been a question we've had a lot about, and the meme stocks that might go hand in hand with speculating versus investing. Josh, did you have an opinion on the crypto and how it might fit within a portfolio?
Absolutely. And this is a question I can't tell you how many times I've received this year, and certainly it's heavily discussed in the media. Where does cryptocurrency fit in, Bitcoin, et cetera? How it should be, should there be something considered in a portfolio? One of the biggest things, guys, when we think about, as we follow this, and I've been fascinated by the blockchain and cryptocurrency, and I certainly think it's something that's here to stay. It's not something that's just a fad. It is going to be something we're going to continue to see develop over time. But the thing about it is it's still in its infancy. It's very, very new, and there's very little regulation around it. And because of that, you're seeing extreme volatility associated with the asset class, which is why, what was it? It was 60,000 at Bitcoin, not that long ago. Now it's 34,000. And so you have to understand, when you think about it as part of your portfolio, that it is falling into the speculative portion of the portfolio, in the sense that you're dealing with something that is going to move up and down at a very rapid clip. And it's not something that's going to be easy on the heart if you get nervous when you see your values go up and down. So what we look at, we're not opposed to having folks own cryptocurrency or Bitcoin. The key is to understand that it should be a very small portion of somebody's investable assets. And then from the idea that from how can we allocate it or implement it for clients, it's not something that we have the ability to do yet here in the United States because there's not any type of approved by the SEC security that allows us to purchase it. And so usually you have to go out and buy that on your own. And there's a variety of different places that you can do that at. And so what we see it as basically an area where it's your play money. It's something that you have to be in a position and willing to understand that things are going to go up and down. And then who knows where the regulatory front comes in and how that potentially impacts.
Yeah. And from a kind of philosophical portfolio building standpoint, one of our core tenets is we invest into things that are transparent, organized, and efficient. And crypto kind of is lacking some of those things. So there's stock markets throughout the world that are not included in our portfolios because they're not either transparent, efficient, or organized. Saudi Arabia is one of them. And crypto kind of falls into that category right now. All those parts are not there that from a philosophical standpoint, we would add it to a portfolio. Now we may get there somewhere down the line. We're just not there yet.
Yeah. And it's certainly, I have one client who has a crypto account and, it's a small piece of a very large pie. And he did it just so he can see what it's all about. But it certainly isn't an over-guiding strategy in the long-term plan. And it is kind of a little bit like the Wild West with that stuff in that, there's extreme volatility we're seeing. And the other part about crypto that's really interesting is from a tax reporting perspective, the requirements around, how do you deal with it on the tax return? Because there's no 1099 that people are getting where they have to, where the gains are reported, right? And so, but that is a self-reporting item for income taxes that we have to sort through now when we prepare taxes as well. So, it's definitely something to take into consideration, but for us, not an overriding core component of any recommendations that we make.
Yeah, I think to Joe's point, I think it's certainly something that could change over time. It's, as I said at the onset, it's fascinating to me and something we follow pretty closely. And I think it's going to continue to develop and ultimately be a part of mainstream life. It's just at a point right now, it's not easily includable in a diversified portfolio. So stay tuned would be the best answer at this point, but certainly would not be opposed to having somebody own small portions of it.
Right.
The other one that we get often during this time, we've seen significant media coverage around meme stocks and around the fact that is that changing the stock market. And so just quickly in terms of what a meme stock is, it's really any type of stock that's seen excessive trading volume from retail investors, not institutional investors, that have been basically targeted this type of company on social media. And so you might have heard things like, the Reddit social media circles where they can promote these types of things. And obviously the best and most common one we've heard of is GameStop. AMC now is one that's been heavily discussed. And so the question becomes, is this something that should we be paying attention to? Is it something we should be worried about? And so that's the question that we've been getting a few times, guys. What do you think about that?
My opinion is it's a company, usually not the entire stock market, and it's typically outlier type of scenarios that are getting the attention. And so there's effectively a small number of people making at certain points a lot of money, and they're trying to impact the bigger traders and having them have a negative on the bigger trader accounts, right? And that was the GameStop with looking at the shorts that were out there against that.
Right.
So So,
And I think, the same like AMC and GameStop. I think there's a little bit of social engineering, retribution aspect to it.
mhm.
Of the little guy investor going against the big Wall Street firm that's shorting GameStop and AMC. And so when a institutional investor shorts, they're basically selling the stock in advance, thinking it's going to go down further than where it's at. And so these small investors are saying, "Hey, we'll drive the price up," and then the institutional investor has to buy the stock not at the lower prices it was expecting, but at a higher price. And so there were some large hedge funds that had significant short positions in GameStop in particular, but also AMC, that had to spend millions of dollars to cover their short positions. And so that was that social retribution aspect of it, which is interesting, but ultimately an outlier in big modern portfolio theory.
And I would say that to just kind of close the door on this in terms of how it impacts all of you listeners and those that are paying attention here, is that this is not going to go away. These retail traders and these social media places where they're trying to promote these stocks, unless the regulators get involved, and then that could have an impact. But the real thing is unless you're a short seller yourself, it's not going to impact you for the most part, in the sense that it's not driving the overall market, to Ari's point. And so, unless you're a big short seller where you could be squeezed out on a short, I don't think there's an impact there. And I do think that you could potentially attract some regulators as you see some of these social media sites. So we'll see where that goes.
Right.
The next the thing as we're
Well,
running out of time.
let me just also say, in all likelihood, we don't own AMC or GameStop in our portfolios, either long or short, because most of our funds have what are called momentum screens, where they're trying to not purchase stocks that have large up or downward swings. So that they're purposely not investing in that type of asset.
Yep.
So, guys, the question that I got here is around: should we be worried about government debt? And I want to show a slide on that, because this is a very common question I think we've received. And kind of just backing up a moment. I mean, obviously, we went through a pandemic. It was a crisis in our country and our world, and the government came in and did a lot of spending to try to shore up the economy, and spent an enormous amount in comparison to any previous stimulus type packages. And so the question is very valid. Are we potentially in a point where we should be very concerned about government debt? I think it's certainly something that should be concerning. But here's one thing that where we kind of have some level of okayness around it right this moment. And here's where you can see on the chart, or on the screen, interest payments on federal debt as a percentage of GDP. And that you can see that it's not costing the government much more than it ever has historically. And that's because interest rates are so low right now. Where this starts to become worrisome is if we start to see rates go up. And then the interest payments as a percentage of GDP could become a bigger problem, which is why I think people worry so much about rising interest rates.
Yeah.
And so right this moment, it's manageable, as folks would say. A lot of economists have said it's manageable, but it's certainly something that has concern over the longer term if we can't stop, some of that, or kind of taper it down a little bit. Any comments from you guys on that?
Well, it's again, to bring it back to the personal level, it's like the mortgage payment. A lot of people are selling the $500,000 home that they bought 15 years ago and buying the $1.5 million home with $1 million mortgage on it, because the monthly payment is less than the $500,000 mortgage they had.
Yeah.
And so that works mathematically, as long as you can lock in that long-term debt and keep your monthly payment at a low rate. And that's, Josh, the risk that we face is, as long as interest rates are low, this level of national debt is not concerning from a GDP standpoint. But if interest rates start reversing, then it can become a significant problem if we don't get the national debt paid down. And so that also is driving a lot of the tax policy coming up is, how do we get the national debt down? How do we pay off some of what we just borrowed?
I feel like the national debt thing has just been a continual topic in the news for the last 20 years. I mean, it's I was on a call a few months ago with a few economists, and none of them can really figure out why inflation hasn't been way worse than it should be based on the numbers, and it's certainly concerning. There's no doubt about it. But a lot of economy, even the brightest minds in the country, are kind of scratching their heads as to, how is it not at a point where we think it should be by now, right?
Well, just because the Fed is, using the monetary policy and using fiscal policy to keep inflation under control and keep, the cost of debt under control.
Yep.
Now,
Yep.
At some point, those, stop working as effectively. So that,
Right.
that can be an issue down the road.
Yeah, no doubt.
The one question came in, how about interest payments as a percentage of federal revenue? Currently, that stands at about 9% of all federal revenue goes towards paying federal interest payments on the debt. So once again, if interest rates go up, that number becomes a much bigger percentage of federal revenue. Now, the good news is that consumers are at their lowest leveraged point that we've seen in a very long time, since the 70s, as a percentage of total assets. And so from the private sector, very healthy balance sheets right now, which I think is encouraging, especially if you kind of compare today, because some people have asked us, how does this compare to where we were in 08, 09? Are we at a bubble? From a consumer standpoint, we are much less leveraged than we were back then. As you can see on the chart, 08, 09, it was closer to 20%. We're now close, down around 12%. So much better from a leverage standpoint. And then, since we only have a few more minutes, I'll just show a few other slides. In terms of this economic recovery, guys, and so the question that we've gotten often is, are we in a bubble? Now that the market's recovered so much from where we were a year plus ago in the pandemic. The market certainly has been forward-looking, and it always is forward-looking. So a lot of this was expected by the market that we'd have this type of V-shaped recovery, and we're starting to see it as the economy is opening up. This is the TSA, checkpoints basically, and you can see we're almost to pre-pandemic levels in terms of how many people are walking through the airports and getting on flights. And as that's happening, you're seeing that kind of pent-up demand of spending and going out and getting that economy cranking again. And that's why we've seen the stock market really start to bounce back. Where we go from here, I think expectations should be tempered in the sense that, you can't have those, fantastic returns consistently forever. And so, obviously the second half of 2021, we anticipate a little bit more coolness and probably a little bit more volatility associated with what's happening with the tax law changes potentially, as well as where we're headed with inflation and interest rates, all stuff we talked about at the beginning.
Yep.
Any other last minute topics you guys want to cover?
I think we covered it all. My notes had the Biden tax proposal, inflation, crypto, speculation, meme stocks, housing, interest rates, stock market bubble, pandemic recovery. I think we hit all the topics we had and thought about, and certainly the questions that we had come across.
Yeah, I think on the housing front, Aria, because we didn't address it much, I'll say quickly, it's a supply-demand issue, plain and simple. 05, 06, we had this huge housing bubble. And then all of a sudden, we had a huge housing crash and a financial crisis called the Great Recession of 08, 09. The result of that was that the developers stopped building. A lot of them, went under as a result of that crisis. And coming back, they were a little gun shy about going out and building huge developments. And then in the meantime, over the last 10 years, this demand has increased dramatically as you've seen millennials aging and growing up and having families and starting to get into buying homes. And now you got all this demand, and especially because of low interest rates and not enough supply. The supply numbers are saying that potentially could be 2 to 3 years at least until we can kind of get that supply up to meet the demand. So my interpretation now is if interest rates stay low, I expect the housing market to stay hot, at least for the next couple of years. So that's my 2 cents on that.
I concur. I don't see demand going away anytime soon. And you overlay a lot of the COVID restrictions with, lease termination moratoriums and everything else. And that also creates other supply issues in the marketplace for folks trying to find places that are available for sale, available to rent, et cetera. So I think the housing market is going to continue to be strong.
So this is the thing on the screen I just want to end with is, we always talk about the idea, guys, of focusing on the things you can control and not focusing on the things you cannot control. And a lot of the stuff we talked about today, we can't control. We don't know what interest rates are going to do. We don't know what inflation is going to do. We don't know what this tax situation is ultimately going to look like. They're very important items and they have an impact on you, but we can't control them. We certainly don't have any control over what the media is doing and talking about and putting into our minds. And certainly the shorter term returns in the marketplace is more noise than anything else. And that's not important. The things that we can control, and we preach about this often, is we can control how we diversify, and although there's a typo in there, how we allocate our assets amongst the different asset classes we invest in, how efficient we can be tax-wise with the assets and income that we do have. And so I think the message to all of our listeners as we go into the second half of 2021 is focus on those things that you can control, and reach out to us as your advisors to help guide you as these new things come to fruition, specifically around tax law and so forth, and let us help you and let us be your guiding source to get you through, any challenges or any, uncertainties that we may face moving forward.
Yeah.
And that was certainly the same message this time last year when, the environment was much more dire, kind of in the middle of the pandemic.
Yep.
So, there's a lot of positive moving forward, I think.
Yeah, one thing that has come out of the last year plus with this pandemic is we've had a lot of inquiries from folks around kind of doing a checkup, and just kind of reconfirming the investment strategies that we have in place for current clients. And then also we've had a lot of referrals come in just to get a second opinion on how their stuff is structured and just to get another perspective. And so we just wanted to remind folks that, we have that service available. So if anyone would like a second opinion or knows someone that does, we do that. It's a pretty efficient process that we go through. So just reach out to us and we can kind of walk you through that process if it's of interest.
Well, thank you all. We rarely go over our time limit, but we had so many things to cover. We probably could have covered even more. So we appreciate you listening. We have more webinars coming up in the second half of the year on a variety of different topics. And we're also going to start more in-person events again in the second half of 2021, which we're extremely excited about. So we appreciate listening and spending some time with us this afternoon. Enjoy the rest of your day and have a great summer.